exporting to the growth markets is our future. There is today a rather odd belief that all these countries are going to do well at our expense, and it's part of this slightly creeping fashionable mood that globalization actually isn't good. It just creates very privileged winners. In my judgment, and speaking in this wonderful building here and everything it represents, we need to stop this rubbish from spreading. The past couple of weeks, the World Bank has published a highly important report updating its estimates of global poverty. And in it, they point out, which is not getting much press at all, that the UN Millennium Goal of halving world poverty was actually met 5 years earlier than they had originally hoped for. And that is because of dramatic reductions in poverty going on in China, Africa, and Latin America. That means the flip side of it, wealth is rising in these countries. And here is a country, as you can see in this picture, Germany, that is already benefiting dramatically from what's going on in this new world. German exports to the BRIC countries at the end of 2011 are already bigger than German exports to France. Already. Within another 2 years, German exports to China will be bigger than German exports to France. And that's not a coincidence as to why Germany is doing so much better right now than the UK and many other countries. The UK, unfortunately, currently exports as much to Ireland as it does to the BRICS. And if the UK is going to have a strong, prosperous decade, we have to find the things that these countries, Mexico included, want to buy. Same is true for the United States. So let me finish off with 3 last charts. When I was talking about the GES scores, I talked about how, because of them improving, contrary to what is frequently said, in my judgment, in the West, the world economy's growth trend is strengthening, not declining. And this chart tries to translate, or this picture tries to translate that into markets. This is a rather complex looking thing, but it's relatively simple in principle. We believe at GSAM that the current so-called equity risk premium, which is the excess return implicitly offered by equities today, or at any moment in time, subtracted off the real bond yield, is the best future guide to equity performance. When it's high, it's going to come down and equities will do well, and when it's low, it's going to do badly and equities are going to weaken. And in order to estimate the equity risk premium, we believe that an estimate of the trend rate of growth of the future is what is necessary, because the role of equities in financial markets is to discount the future in terms of earnings. And if you do that today, using the rising importance of the BRIC and growth market economies, what you will find, unless you have some dramatically pessimistic views of the West, you'd have to have dramatically pessimistic views, is in a truly measured world, the world economy's growth trend for this decade is more than 4%. This is the start of my 31st year in our wonderful industry, and over the past 30 years, the world economy has grown by about 3.4. And so because of the growth market economies, the world economy is strengthening, despite what is happening in some, not all, some Western countries. And as a result of that, if you go through the various other simple components that are necessary to calculate such a measure, in particular because we're in an era where dividend payments are so high, and because real bond yields are so low, today's equity risk premium is really high. And that is why global equity markets find it so relatively easy to rally whenever Greece is not on the front page of our newspapers. Let me finish on the back of that by linking it all together as to how we believe investors should be thinking in terms of this new world. When I came into my, I still call it new role, it's now 18 months, I believe that the market cap benchmarking approach for investors had lived past its usefulness. Because it, particularly in equities, tends to give far too much weight to very fashionable Western brands, and therefore they become more and more powerful part of indices, which is great when they're going up, but as soon as something changes, you do not want to be involved in those. And there's a lot of evidence from quantitative analysis that it is a dangerous investment strategy. And so I believed that a GDP-weighted approach would be more sensible. And that's true whether it's in fixed income or equity. Right now, if it were in fixed income, that would imply, unless you do GDP weighting, you'd want to be investing more and more in Greek bonds and Japanese bonds, which I don't think is a very smart thing to do. So if you move to a GDP-weighted benchmark, you get a little bit of a different, more controversial approach, but it gives you a better flavour. What I hadn't fully appreciated, and that I was in some ways being a bit naive, is that from an equity perspective, doesn't take account of the growth Western-based companies are doing for you with their own business expansion in the growth market world. Here in the UK, we need to have a few more of those. In Germany, there are hundreds of them. I often think of Germany and its stock market as being developed market brick. But what the third column shows you, where it says GSAM, is our approach to this, and the way we are trying to advise investors is if you constrain an overall portfolio by less volatility, so you avoid getting wrapped up in indices that are dominated by fashionable, individual, rapidly rising market cap stocks, and examine companies based on their global revenue exposure, irrespective of where they are located, and then optimize it all, you end up with a neutral portfolio which actually has nearly double the weight to growth markets than in a market cap benchmark, with less volatility. And highly relevant for Mexico in that regard, as you can see, a benchmark which is double that of a market cap approach. Thank you very much. Let me stop there.
What do you see as the main reason why British investors are not actively going into Mexico?
Might be a question for the ambassador rather than me. Ah dear. I would say there are probably three. Probably. Let me quickly add. Yeah, I'm no expert on that answer, but let me never stop me talking, so let me offer three. I think first of all, as reflective of this depressed mental state, for some people, Mexico being right next to the United States is not a good thing. There is a mindset that the US days of leadership of the global economy are finished, etc., etc., etc. So anywhere close to the United States, that's, it's not trendy. Secondly, of course, Mexico itself has